Dear students, we will do module 20. This is about computation of pension. Just like gratuity, computation of pension is also an important concept in salary computation. So I will explain the theory and we will do some problems also. So computation of pension divided into two main headings. One is uncommuted, and second is commuted. So here you have to remember, uncommuted pension is otherwise called periodic or normal pension. It's fully taxable. Students always make mistake between uncommuted pension and commuted pension. I will make it simple. If an employee is working, till his retirement he will get salary. Next month onwards he will supposed to get the pension. That meaning, just like salary, uncommuted pension is fully taxable. Now what is commuted pension? Say for example, you are getting 3 lakhs, 30,000 as pension. 30,000 as pension. You got the option. Usually when they are giving the pension now, they commute and give. Now what is commuted? See for example, their life expectancy is more. People are living for more number of years. So the government, what they will do? They will give us a lump sum amount saying that it's commuted. Say for example, 50% of the salary is commuted. That meaning, lump sum amount you will get plus your 30,000 salary will reduce to 15,000. Because you are commuted 50% and you receive the lump sum amount. If you are commuting 1/3, so then your salary, your pension will reduce to 10,000 is commuted, balance 20,000 will be your normal pension. So uncommuted pension will be fully taxable just like salary, irrespective of whether he is a government employee or a private sector employee. For everyone, it's just like salary income, it is taxable. But for commuted pension, government employees, it's exempted. So that is the difference. This is very important concept in computing pension. Now tax exemption for non-government employees is divided into two. One is those who are receiving gratuity and those who are not receiving gratuity. If you are receiving gratuity, 1/3 of the full value of pension is exempted. If you are not receiving gratuity, 1/2 is exempted. This is also an important concept. So if the employer receives gratuity, exempted amount shall be commuted value of 1/3 of pension which is normally entitled to receive. I have to explain with the problem, I will make it clear. If the employee does not receive gratuity, the exempted amount shall be commuted value of 1/2 of such pension. Now who are government employees? Government sector employees include central government employees, state government employees, local authority employees, employees of a corporation set up under central, state or provincial act, employees of public sector undertakings, judges of Supreme Court and High Court of India. Now first problem we will do. Then you will understand what you mean by commuted and uncommuted. Compute the taxable pension of Mr. K, retired from a public limited company on 31st August. Date is important, 31st August 24. And his pension was fixed at rupees 50,000 per month. Rupees 50,000. Then the next thing is, he does not commute any part of his pension. And pension is payable on 1st of next month. So how many months he will get pension? So your previous year is 1/4/24 to 31/3/25. So he retired on August 31st. September he will not get because pension is payable on 1st of next month. So October, November, December, January, February, March, 6 months pension he will get. He has not commuted. That meaning full pension he is getting 50,000 into 6, rupees 3 lakhs. It's fully taxable because it is uncommuted pension. So this is the first computation. Second computation, Mr. K retired from government service on 30th September and his pension was fixed at 10,000 per month. Retired on 30th September, 39/24. 39/24. His pension was fixed at rupees 10,000 per month. So this is 10,000. Your previous year. Now the value is, you have to calculate the value, that is September he retired. He did not commute his pension. Pension becomes payable on first day of next month. So October he will not get. November only he will get. September pension will be payable on November 1st. November, December, January, February, March. So for 5 months, 10,000 into 5 rupees 50,000 fully taxable uncommuted pension. So this is the second problem I wanted to explain. Always remember, uncommuted pension is taxable just like salary for government and private sector employees. Then third problem, Mr. K retired from Karnataka government service on 30th June 24. 30th June 24. 30th June 24. His pension was fixed at rupees 30,000 per month. His actual pension 30,000. 30,000. He got 1/3 of his pension commuted. 1/3 he has commuted. And he got a lump sum amount 6 lakhs. He is a government sector employee. 6 lakhs is fully exempted. That is one thing. His pension is payable on the 1st of next month. So what will be his taxable salary? So this is fully exempted government sector. Now he has commuted 1/10. So 30,000. So balance pension payable is 20,000. 1/3 he has commuted. So his pension will reduce to 20,000. Now he is 30 June he retired. August 1st onwards he will get. August, September, October, November, December, January, February, March. 8 months. 8 months, 1,60,000. See, when the salary or pension is payable on the last day of the month or first day of next month, months will change. So you have to be very careful about that. Next problem. Mr. R retired from a private company on 30th April 24. 30th April 24. 30th April 24. And his pension was fixed at rupees 15,000. 15,000. 15,000. And he got 50% of his pension commuted and got 8 lakhs. 8 lakhs. 50% meaning the after commutation pension is reduced to 7,500. He got his pension commuted on January 25. January 25. Pension is payable on the 1st of next month. So how many days? Uncommuted pension 15. This he got on January 1st. January 1st, that meaning Feb and March he will get 7,500. Remaining months he will get 15,000. Why? Because January he has commuted. So uncommuted pension 15,000 into 8. April he retired. So June, July, August, September, October, November, December, January. 8 months he will get 15,000 because salary is payable on the 1st of next month. 15,000 into 8. So he will get this plus uncommuted pension for 2 months. 7,500 into 2 because he commuted in January, meaning February 1st and March 1st he will be getting only 7,500. So 1,20,000 plus 15,000. 1,35,000. 1,35,000. 1,35,000. Now table showing the value of commuted pension. He got 8 lakhs as commuted pension. See, this is uncommuted pension fully taxable. Uncommuted pension fully taxable 1,35,000. Now he is a private sector employee. So what is the treatment for commuted pension? 8 lakhs he got. 8 lakhs. Now he has received gratuity also. That meaning 1/3 of the full value of the commuted pension will be exempted. 50% is 8 lakhs. So full value will be 16. Full pension would have been 16 lakhs. Because this is 50%. So 100% is 16 lakhs. So 8 exempted pension is 16 lakhs into 1/3. Into 1/3. So the value is 5,33,000. 5,33,333. This is the exempted value. I will tell you what most students will do. They will reduce this value from 16 lakhs. 16 lakhs is not the salary, what the pension we received. We received this value. So exempted or taxable pension is This is the exempted pension. Now taxable pension is 8 lakhs minus 5 lakhs 33,333. So the value is here the value is 2,66,667 is taxable. So this is the computation. Now next problem. Mr. R retired on 31/12/24 and his pension was fixed at rupees 36,000 per month. Date of retirement is important and when he is getting the pension, end of the month or next month. So here R retired on 31/12/24. 31/12/24. Now, and his pension was fixed at 36,000. 36,000. He got 3/4 of his pension commuted, for which he received 18 lakhs. 18 lakhs. 18 lakhs, that is 3/4. Find out the commuted value of pension if he is getting gratuity and if he is not getting gratuity. So here you have to remember, pension is payable on the last day of the month. All the problems we worked out as pension is payable on the first of next month. Here it is getting on the last day of the month. So uncommuted pension, if you take 3/4 of his pension commuted. So the balance value is 9,000. Now every month he will get. So how many months he will get? 9,000 into 3. So 27,000 will be the uncommuted pension. It will be fully taxable. See, pension is payable on the last of the month. 3/4 is commuted. 27,000 is commuted and he got this value. So the balance payable is 9,000. 36,000 divided by 4, 9,000. 3 portions he has already commuted. So the 27,000 is fully taxable. Now if he is receiving gratuity, commuted pension, 3/4 of the pension is commuted. So his full pension will be 18 lakhs into 4/3. That meaning 24 lakhs. That will be his full pension. If he is receiving gratuity, 1/3 will be exempted. Into 1/3 meaning 8 lakhs. Taxable pension is 18 lakhs. 18 lakhs minus 8 lakhs. So that is 10 lakhs. Please remember, you don't subtract from this. This is the value you got. From here you have to subtract. Most of the students will subtract from this value. It is a mistake. Now, if his uncommuted pension 27,000, I have explained how he is getting for 3 months. Since pension is payable on the last of the month, January, February, March, 3 months, 9,000. Now, if he is not receiving gratuity, half of the value is exempted. That meaning 1/2. 1/2 is 12 lakhs. 1/2 is 12 lakhs. So 18 lakhs minus 12 lakhs, how much he will get? 6 lakhs will be taxable. So 6 lakhs will be the taxable value. 6 lakhs will be the taxable value. This is what I wanted to explain. Computation of pension is an important concept in salary. So you have to learn this in detail. So the problems: uncommuted, commuted, when salary is payable, last day of the month or first of next month. Then date of retirement is very important. So you have to calculate, and please feel free to give your suggestions. Happy learning. Thank you.